Have you ever watched the market just completely nosedive and felt that knot of pure panic in your stomach? That feeling like, I gotta sell. I have to sell right now before this whole thing goes to zero. Well, today, we're gonna take that fear apart piece by piece. We're gonna go on a little journey, from the chaotic, emotional world of the panicked herd to the disciplined, opportunistic mindset of a professional investor staring a market crash right in the face. Okay, let's get into it.
So, here's our game plan. We're going to tackle this in 6 parts. First, we'll dissect what a flash crash even is. Then, we'll look at the 2 paths every investor faces, pure panic or a professional protocol. After that, we'll pull back the curtain on the insurance pros use, how they get clarity in the chaos, and how they turn that crisis into a huge opportunity. And finally, we'll tie it all together so you can start building your very own crisis protocol.
All right, let's jump right into the heart of the fear itself. What in the world is a flash crash? Well, it's this totally modern thing where prices just plummet with terrifying speed. And the crazy part is, it's often not even driven by people, but by computer algorithms just going haywire.
I want you to just picture this for a second. You're watching the market, everything seems kind of normal, and then, in minutes, the Dow Jones drops almost 1,000 points. We're not talking about a slow, painful grind down. No, we're talking about a 9% drop in a single afternoon. And this isn't some made-up scenario. This is exactly what happened back on May 6, 2010.
Just look at how fast this all went down. It starts with some regular market anxiety over the Greek debt crisis. But then, this one huge automated sell program from a mutual fund. It's like throwing a lit match into a room full of gasoline. In minutes, high-frequency trading bots, they just take over, creating this insane feedback loop of selling that literally makes all the buyers disappear. We go from a little nervous to a 1,000-point drop in about 15 minutes. And then, and this is the wild part, just as quickly, it snaps right back. This wasn't human panic. It was pure, unadulterated, machine-driven chaos.
So the key thing to get here is that a flash crash is all about its speed and its cause. This isn't like the 1987 crash where humans were on the phone screaming, "Sell!" This was a battle of the bots. It's this super fast, violent price drop caused by a perfect storm of automated systems all freaking out at the same time and amplifying each other's moves until the whole system just temporarily breaks.
Let's dig into that a little more. The spark, the catalyst, was real-world fear. You had riots in Athens. That made a firm called Waddell & Reed want a hedge to protect themselves. But here it is. Here's the fatal flaw in the system. The algorithm they used was programmed to sell based on the volume of trading, not to sell at a certain price. So as it sold, the volume went up, which told the algorithm to sell even more and even faster. It became this self-reinforcing death spiral. Other computers saw this happening, pulled their buy orders, and poof, liquidity just vanished. For a few terrifying minutes, there was no floor.
So that event, it perfectly sets up the 2 paths any investor can take. When the machines go nuts and your screen is just a sea of red, your reaction is absolutely everything. You can either join the stampede off the cliff, or you can stand your ground armed with a protocol.
And this slide really lays out the 2 mindsets in stark contrast, right? The panicked herd is running on pure, raw emotion. Their only thought is, get me out of here before this thing hits zero. They're basically lemmings heading for a cliff. The professional, they operate totally differently. They're using a pre-written, rule-based system they created when they were calm and rational. So their first thought isn't, how do I escape? It's, wait a minute, is this a buying opportunity? They are a contrarian by design.
You know, the legendary Benjamin Graham, the guy who mentored Warren Buffett, he knew this stuff decades ago. He understood that the biggest risk you face in investing, it's not the market itself, it's you. It's our own emotional, hardwired human brain. We are built to fear loss way more than we enjoy gain, and that makes us sell at the absolute worst possible time.
To explain this, Graham came up with this brilliant character, Mr. Market. Imagine you own a business and your partner is this guy, Mr. Market. Every single day, he shows up at your door and offers to either buy you out or sell you his share of the business at a new price. Some days, he's just euphoric, totally giddy, offering you ridiculously high prices. But on other days, he's deeply depressed, and he's willing to sell you his shares for pennies on the dollar. He's a total manic depressive.
So, what's the big secret? The pro knows that Mr. Market is, well, a lunatic. You'd never let an emotional wreck make your business decisions, so why would you let him make your investment decisions? The pro just ignores his crazy happy moods, and they take full advantage of his depressed ones. When Mr. Market is in a full-blown panic, offering to sell you his shares for a stupidly low price, the professional investor calmly steps up and says,
Yes, please. I'll take them.
Okay, so how do pros get the confidence to actually buy when everyone else on the planet is selling? Well, it's not just about being brave. It's about having an unshakable defense, a kind of insurance policy they built long before the storm ever hit. Let's break down how they do it. The legendary trader Bruce Kovner he nailed it with this quote. The whole goal is to never ever be in a spot where you're losing a ton of money and you have no idea why. If you're surprised by a big loss, it means you didn't have a plan, you didn't understand your risks. A pro's entire approach is designed to get rid of those kinds of nasty surprises.
And a huge part of this defense is something called hedging. Honestly, the best way to think about it is exactly like insurance. You own a house, you buy fire insurance, right? Well, if you own a big portfolio of tech stocks, you might buy another investment, like something called a put option that basically pays you money if the whole tech sector goes down. It's a small, known cost to protect yourself from a total disaster.
This is so important. Nobody has a crystal ball. Professionals do not waste their time trying to predict the exact day the next crash is going to happen. Instead, they just focus on being prepared. And this analogy from the source material is perfect. When you're driving and you hit an icy patch of road, you don't try to predict the exact spot you'll skid. You just slow down. In investing, that means taking some risk off the table when conditions start to look dicey.
Now, to prepare the right way, you have to know what you're preparing for. And there are really two big types of risk. The first one is called non-systemic risk. This is when something bad happens to just one company. Think of the BP oil spill. The rest of the market's doing okay, but BP stock gets crushed. Your defense there is pretty simple: diversification. Don't put all your eggs in one basket. But the second, much scarier risk is systemic. This is when the entire system is in trouble, like the 2008 financial crisis. Diversification doesn't help you much when everything is going down at once. That's where your real insurance, your hedging, and your asset allocation really save you.
Okay, so this toolkit, this is where the rubber meets the road. It's a defense in layers. First, asset allocation is your foundation. Deciding your mix of stocks, bonds, and cash before the panic, that sets your overall risk level. Second is position sizing. This is your circuit breaker. It means you never have so much money in one investment that if it goes to zero, it blows up your whole portfolio. Third and fourth are diversification and hedging, which we just talked about. And finally, number 5, stop-loss orders. Think of these as your preset eject button. They're automatic sell orders that trigger at a price you decided on, getting you out of a bad trade before your emotions can talk you out of it.
Now, building this whole defense system, it isn't just guesswork. It's based on analysis. But here's the key again. Pros use analysis not to predict the future, but to get clarity and confidence in their decisions. That's what allows them to just tune out all the emotional noise from the market.
So there are two main schools of thought here, and most pros actually use a mix of both. Fundamental analysis asks, what should I buy? It's all about digging into the company itself, its earnings, its debt, its management, to figure out what it's really worth. It asks the question, is this a good company? Technical analysis, on the other hand, asks, when should I buy? It's all about studying the charts, the price action, the trading volume, the trends, to try and figure out the market psychology. It's less about the business and more about the behavior of the crowd.
And this is where it all comes together. The preparation, the risk management, the analysis, it all leads to this one moment, the moment of crisis. And for the professional investor, this is not a moment of fear. This is the moment they have been waiting for.
I mean, you knew this quote was coming, right? Nobody has ever said it better than Warren Buffett. This one sentence, it's the ultimate contrarian's Bible. It's all about having the emotional strength and the financial means to buy when everyone else is selling in a blind panic, and to be cautious when everyone else is getting euphoric. It's so simple to say, but almost impossible to do without having a protocol in place.
So let's go all the way back to that chaotic afternoon in May 2010. While average investors were glued to their screens, panic selling, watching their life savings just evaporate, what do you think the prepared pros were doing? They weren't selling. They were pulling out their watch lists, licking their chops, and seeing the sale of a lifetime unfolding right in front of them.
For a few crazy moments during that flash crash, you could buy shares of Procter & Gamble, one of the most stable, blue-chip companies on Earth, a company that had been trading around $60 for about $40. I mean, it was a price so absurdly, stupidly low that no rational human would have ever sold it there. But the algorithms did.
And it wasn't just P&G. For a split second, you could have bought Apple, one of the most innovative companies in the history of the world, for about $28 a share.
These weren't failing companies. This had nothing to do with their actual value. This was just Mr. Market having a complete psychotic breakdown and offering you gold for the price of lead.
But here's the thing. You can't go shopping during the sale of the century if your wallet is empty, right? You just can't. And that's why a professional single greatest weapon in a crash is something they call dry powder. It's just a cool name for cash, held in reserve specifically for moments like these. It's the ammunition they need to act on their plan. While everyone else is fully invested and forced to sell into the panic, the pro has cash ready to deploy into the fear.
And you know what? History shows that having the courage to buy during these moments pays off big time. Whether it's a super shark V-shaped recovery like we saw after the '87 crash and the 2010 flash crash, or a slower, more grinding U-shaped recovery like after 2008, the market has always come back. The greatest rewards go to those who can ride out the storm.
Okay, so we've seen the anatomy of a crash. We've seen the mindset of a pro. Now let's make this real. Let's turn all this information into action. How can you start building your own crisis protocol, like today?
This is it. This is your personal protocol checklist, and you have to do this before the next crisis hits. 1. Define your rules. Literally write down your plan for buying, selling, and holding when you are calm and rational. 2. Know your risks. Figure out if you're exposed to a single company going under or the whole market taking a hit. 3. Build your defenses. Decide your ideal asset allocation and position sizes ahead of time. 4. Prepare your watch list. Know exactly which great companies you'd love to own if they ever went on a massive sale. 5. Keep that dry powder. Always have cash ready to go. And finally, number 6. Master your emotions. The next time you feel that panic creeping in, recognize it. Not as a signal to sell, but as a signal to take a deep breath, step away, and trust the protocol you already built.
So let's end with this. We don't know when the next crash will happen, but we know with absolute 100% certainty that it is coming. So the only question that really matters is how are you going to be positioned when it arrives? Will it be a threat that wipes you out? Or will it be the opportunity that you've been patiently preparing for? The choice is entirely yours, and the preparation starts right now.